G'day folks, welcome back to another update for high-grade copper and US crude. Copper continues to rise and US crude has hit support. We're going to include a back testing in our review as well. Don't forget to hit that like and subscribe button to support the channel. But first, looking at some outlook for both US crude and copper. For crude oil, oil prices have experienced volatility due to geopolitical tensions, including the new US sanctions on Iran and concerns over a potential global recession. The US oil and gas rig count increased for the first time in 3 weeks, indicating a potential rise in future production. The International Energy Agency forecasts a non-OPEC plus production to rise by 1.5 million barrels per day in 2025, led by the Americas, while OPEC plus output could hold steady if voluntary cuts are maintained. For high-grade copper, prices have surged over 20% in 2025, reaching approximately $9,914 per metric tonne, driven by potential US tariffs, leading to stockpiling and supply constraints. Chinese smelters are undergoing extensive maintenance due to a severe shortage of copper concentrate and negative processing fees, affecting nearly 8% of the country's smelting capacity. The global push for electrification and renewable energy continues to bolster copper demand, with electric vehicles requiring significantly more copper than traditional vehicles. So I'll start off with US crude first. So on the monthly, the price and the CCI is below the moving averages, indicating a bearish momentum. On the weekly, likewise bearish, and notice we've got a bit of a slight pullback with that last week's of trade. It's just a bit of a very slight bullish candle, but still bearish on the weekly as well. And on the daily, it's actually hit this support at 65.04, and it looks like it's broken up through the CCI moving averages, and it's almost a fresh breakout above the price at moving averages as well. About to turn bullish, first time in a long time. Now, if we go to the micro level, we want to look at the 1 hour chart as well. So here we've got the daily chart as a reference. So taking long trades only in accordance with the daily trend. But notice actually back here we did have a anticipated bounce. We had a double bottom there on the price versus higher highs on the CCI. And that actually bounced. And if we took a Fibonacci range, let's take it back to that level there. From that low to that high, you can see that it's broken quite easily through that 38% Fibonacci range. That's a minimum retrace level to touch that range. In this case, it's actually broken just above that 38% level. But notice the CCI is still bullish above the moving averages, and so is the price, although it looks like it may pull back sometime soon, so just be cautious of that. There's no current divergence at the moment on the hourly, nor is there one on the daily. So in terms of back testing, what we've got here on the daily, we take that as a reference. So currently you're only going long. You're about to start to go long as well as soon as that breaks above that moving average on the daily. But back here we've got the back test for a short positioning, and those for the stop loss approach and the average down approach. They started back during that period on the 21st of February, back on that period there. You could have taken it back there, but just to show you the short-term range on the stop loss approach, you would have stopped it out the first time at those crosses. And the reason for that is because the CCI broke into just touch that moving average range, and then you would have re-entered, as shown by the various stop loss approach and the average down approach there, and then you would have stopped it again on the second crosses there when the CCI broke into that moving average range, and you wouldn't have taken any further positions after that going short. But on the first time, you see there on the stop loss approach, the top chart shows you a profit of $2,895 versus the average down approach generated $8,069. And what you've re-entered, then a second lot of trades on the stop loss approach, the top one generated $4,779 approximately, and the average down approach generated $6,637 with those potential trades. So again, you would have taken those little losses on the average down approach. Again, you don't want to hold on to it once the CCI breaks into that moving average range on the daily chart. Also, you would have noticed here, based on the 1 hour time frame we mentioned, the double bottom here on the price versus that bullish divergence on the CCI. So you would have paid attention to that, and that would have been another area to go to confirm your long positioning. But again, you wouldn't have gone long because the daily chart was in a short positioning. So again, avoid. That's probably would have been a nice area to close out your position once you started seeing the price appreciate during that period. So that would have been ideal to close out your short positions at that point there. So for high grade copper, on the monthly, the price is well above the moving average range, giving us a nice big bullish momentum. Likewise, the CCI is bullish. So bullish momentum on the monthly, bullish momentum on the weekly as well. Both the CCI and the price trending higher than the moving averages. And on the daily, we've actually hit this hard resistance up here at 51,740. Now you'll notice here as well on our previous video, we drew this bearish divergence versus higher highs on the price. Now, as I always say, you want to wait for that price to retrace before getting excited and starting to potentially, I don't trade these divergences, but you want to be careful in terms of how you watch these. In this case, literally immediately after that video, the price kept rising and the CCI kept rising, which is a key thing to look out for. So in that case, it invalidated the bearish divergence. So we're going to delete that bearish divergence trend line. So there was no divergence there. And at the moment, it's hitting this resistance, as I said, and it may well come back with a couple of bearish candles there. And the CCI is also retracing. So again, no divergence on the daily. There was a small bullish divergence back here versus double bottom on the price, and that bounced, hit our minimum target, retraced back to the downside, then it bounced off from there. So that actually hit our minimum target range. If we go to the intraday chart, the 1 hour chart, again, trending in the direction of the daily, you would have taken only long trades, and they would have been those little trades there when it broke above the moving average of the CCI and the price, and you would have closed it out when the price and the CCI broke in below the moving average range. A couple of false breaks there, but you probably could have stayed in the trade as long as the price was well above the moving averages, and then closed it out finally when it broke into that moving average range, taking your profits at that one there. So I've got the back testing to show some examples. So what I've got here on the 1 hour time frame, again taking the direction of the daily, going back to the 4th of February when the CCI broke above the moving average there, and also the price broke above. That's where this back testing starts. So for the stop loss approach, and you would have taken your first exits when that CCI on the daily broke into that moving average range there, as indicated by that spot and that spot. So the stop loss approach at that level, let me get rid of that. The stop loss approach at that level up here generated $472, and the average down approach at that level generated $7,012, and that's because of those multiple contracts added. You would have waited and avoided going short. Well, you could have gone short actually. No, you would not have gone short because the price is still above the moving average range, and you would have waited, then gone long again there, and that would have started, let me just mark that with a tick. So you would have started going long again at that point there, and from that point on you would have closed it out the first time. So that would have been a small loss on that one when it broke into that point there. That would have been about a break even, and then gone long again when the CCI broke above the moving average range there, which would have been at that point the next day, yeah, at that level there. And you'd still be in the trade today. You're about to close it out, but you can see there a couple of small losses there, but overall the average down approach generated 27,936, and the stop loss approach generated 3,774, accounting for a couple of small losses there, maybe a couple of small break-even losses there as well. Take a few dollars off that, but overall you can see the result that would have been reaped in that area. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade one contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is one contract, next lot is 3, you got a total of 3 contracts now running. Add another 4, you got a contract, 7 contracts running, add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest one contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000. Take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.